Well, hey there, everyone. Happy Tuesday, November 18th, 2025, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of classic fall day here in Redmond, Washington. Hope you guys are all doing well. Hope you had a great weekend. We were off yesterday, traveling back from New York. Had my daughter on a college tour in the New York area. Great trip. Maybe getting closer to some sort of sense of what's going to be next for the Keller family in terms of colleges, but enjoyed some quality time with my daughter for sure. Hope you guys are all doing well. Thanks for some flexibility here as I took off a couple days from the show just to get there safely and get back. Since our last episode, which was last Thursday, have we gained any additional clarity? Honestly, I think so. I think mid last week, you could probably make some sort of argument, and I certainly saw plenty of that from people I respect greatly, talking about how conditions are great and everything is fine. As you probably know, if you've been watching the show, we've been talking about things like the Hindenburg Omen, about deteriorating breadth and momentum. So for us, the signs of deterioration, particularly under the hood, have been significant. And as we covered, this market remains strong as measured by the S&P 500 and the Nasdaq if mega cap growth stocks remain strong. And I think the problem that we're seeing is that is less and less the case, right? It started with stocks like Meta breaking down, but now it turns out that was the leading indicator of other deterioration from charts like Microsoft, now looking more and more like a big double top pattern. And others. Now we're starting to see breakdowns in things like Dow theory, which is more of a lagging indicator that confirms a market in a bearish phase. We've seen additional signals from the Hindenburg Omen just continuing to flash that warning sign. So for me, this is a time to be cautious. This is the time to think more defensively. I think as we're seeing from the S&P 500 and other charts today, dip buyers are not really manifesting in a meaningful enough way to cause the market to move higher. Having said that, things are still okay, right? And we're not far off of all-time highs, right? It's not a doomsday moment just yet. It's just I've seen a lot of bear market phases before, and the beginning of bear markets often feels a lot like this, where a lot of people are resisting it, right? Very few people believe that any sort of bear market has happened until there's enough deterioration that it's impossible to ignore. And we'll see. I think the charts will prove out what's gonna happen here. But when we think about elevated volatility, we think about leadership rotation. Those are some of the key charts we'll be talking about here today. All right. With that in mind, the structure of this show, we're back to a normal sort of general broadcast approach. So what we're going to do is 3 parts. We'll start talking about sort of a high-level review of market conditions. What did we learn here on Tuesday, November 18th? We'll then look at the market carpet on stock charts, which is a heat map style visualization, which allows us to focus a little bit more on thematic plays within the equity space. What stocks were working, what stocks were not, what charts stand out that we should probably look at. Then we'll go to a full chart review where we'll break down some of the key charts that I've hand-selected after spending the day doing charty sort of things. And focus on the key messages I think we should be aware of as investors. As a reminder, we welcome your questions. Please use the comment section on our YouTube channel liberally. Any questions that come up as I'm sharing charts and ideas and perspective with you today, would love to hear them. We actually did not get to an all mailbag episode on Friday, although I actually did get some great questions together. So time permitting, I will do one of those for sure, and share some answers to some thoughtful questions we've received. With that in mind, though, let's get to the markets today. So further deterioration here with the S&P 500, still above our line in the sand at 6550, but that 6550 level is getting closer and closer every trading day. It feels like the S&P did finish down about 0.8% to 6617. And change. The Nasdaq Composite down a little bit further, down 1.2%. The Dow Jones Industrial Average down 1.1%. Mid caps and small caps actually a little bit better. The mid cap S&P 400 was actually up about 0.3%. Small caps were essentially flat for the day. Biggest concern here on page 1 would be the VIX. The VIX did finish finished Monday's session. Friday it actually finished just below 20, if I remember right. Monday actually pushed above. Today on Tuesday we have another 2+ VIX points up to almost 25. So according to the volatility reading using the VIX, we are no longer in a low volatility environment. We are now in a high volatility environment. I think the rules are different with the VIX above 20. I think the rules are different when we're in a low volatility environment versus a high volatility environment. Remember what the VIX is actually telling you. That's telling you that we should have an expectation for bigger day-to-day percentage swings in the S&P. That's literally what that number is meant to imply. It's an implied volatility. It's what the options market is pricing in terms of the expected day-to-day movement in the S&P 500. So with a VIX below 20, you expect little moves, right? You don't expect 1% plus moves on a normal trading day. VIX above 20, we should start to expect daily percentage swings up or down at a much higher range. And so expect bigger moves is what the options market is telling us with the VIX in the 25 range. In terms of bonds, kind of mixed today. The midpoint of the yield curve, the 5-year and 10-year points were slightly lower as bonds generally moved a little bit higher. But the TLT really finished flat for the day. The dollar up a little bit here, but not by much, just 3 points, 3 cents on the UUP, which is a dollar ETF. Precious metals continuing to look quite good. Yesterday on Monday, kind of a choppy session for gold, really rotated lower until around 3 o'clock yesterday. Nice rally into the close today, opening much higher, which ended up basically being for the high for the day, which we retested right around 3 p.m. Eastern. So gold, silver, both in the green. On a day like today, when stocks were down, when risk assets were down, I think it's super valuable, super important to focus on what was actually up. Gold, silver, crude oil stand out for sure. Cryptocurrencies starting to diverge a bit from stocks, although they did roll over here in the last couple hours. Bitcoin currently trading slightly higher. Now that's bouncing off of, I would argue, support around 90,000. It did undercut that a little bit in the last 24 hours, but that's a big round number. On my chart of Bitcoin, as we'll see here in a little bit, I usually put horizontal lines at the 10,000 increments because more often than not, when the price approaches one of those levels, you will have at least a short-term reversal. What you will see is that has happened yet again, as it has happened so many times. And it happens so often, I just got in the habit of putting those horizontal lines there. And I'm glad I have it on the day like today because it's just a great reminder of recognizing short-term reversals around key large increments. Ether prices up a little bit higher to 3,100. That's up about 2.5%. You can see all 10 of the top 10 coins followed on the stock charts platform in the green today. All right, looking at the S&P 500 sectors, energy at the top of the list. The XLE was up 0.8%. Healthcare number 2 and communication services number 3. They were both up about 0.6%. So the biggest gainers sector-wise were not huge upswings. Right? There wasn't some big positive outlier. All of these sectors that outperformed today were not up very much, right? Up less than 1%. You can see 6 out of the 11 S&P sectors finished in the green today. So it was really sort of a split, about a half and half split. But the problem here is on the downside. The 2 sectors losing the most: consumer discretionary down 1.9%, technology, the XLK down 1.6%. Those are 2 of the largest sectors in the S&P. Obviously, a lot of the growthy names that have been the leadership going into October, November, and now we're seeing them essentially starting to lead on the way down. Industrials was 3rd from the bottom, but a big jump to about 0.5% down for the day. Breadth actually didn't end up being that bad, which is kind of interesting. Earlier in the day, the breadth conditions look a little bit worse. Today, New York Composite Index, which is the top line here, advancers 54%, decliners 44%. That's decent. Nasdaq Composite 49 to 47%, S&P 51 to 49%. Mid caps, the mid cap index was was the best performer out of this list of indexes. About a 2-to-1 ratio, 63% up to 37% down. So the breadth wasn't horrible today. And what you'll find, and this is something we talked about, I wouldn't be surprised if breadth conditions improve as the S&P and the Nasdaq rotate lower, which is a little counterintuitive, but that's what happens when we have had narrow leadership. When the market's been moving higher on weaker breadth, I wouldn't be surprised if the market, as measured by the benchmarks, if the benchmarks rotate lower while breadth improves, because what that would imply would be a rotation away from technology and consumer and communication stocks, which would mean you were rotating into other stocks like defensive sectors. Those are smaller weights. And so you actually could see a situation where breadth improves while the indexes go down. I think that would actually be a very logical outcome based on what we've seen. Our market trend model as of last Friday's close, which is when I formally update this market trend model, was bullish on all time frames for the S&P. The week prior, 2 Fridays ago, the short-term model turned bearish. Last Friday, just 4 days ago, short-term model was back bullish for the S&P 500. If today was Friday, which I'm well aware it is not, but this widget on stock charts updates every day after the close just to refresh. But I don't formally change the model until Friday. So what this basically is telling you is if today was Friday and if this was the end of the week, this is what would happen to our market trend model. Short-term model, bearish across the board for U.S. equity indexes. Mid-caps would actually be medium-term bearish as well, and that has not happened often for sure. All right, the Magnificent Seven and Friends leading growth names. Netflix continuing to look not like anything else, right? The chart of Netflix was one of the sort of early breakdown names. Mid-October, Netflix had a big gap lower on earnings, ended up stalling down around 108 or so, and it's bounced off of there a couple times. Over the last 3 days, it's not a perfect example. It's not my favorite example of a, what is that called? A morning star candle pattern, right? 3-bar pattern. We have a big down day, sort of a smaller day, and then a big up day. It's not a perfect example, but it's close enough that I think it's a decent representation of the 3-bar rotation. Down day, sort of a consolidation day, then a big up day. It's short-term bearish for Netflix. Elsewhere here, we can see Apple was flat. The problem here is on the bottom. Amazon down another 4.4% today. NVIDIA, which is kind of the earnings report to be looking at, that's tomorrow, down 2.8%. Microsoft down 2.7%. I would say the chart of Microsoft is one of the more concerning ones. Some of these have not looked good. Like Meta has not looked good for a while, so it's down again today. But that's already been a bearish chart, I would argue. Microsoft has been kind of neutral. It's been kind of hanging in there. Double top pattern, but it hasn't really broken down. But now we're actually seeing start to lose some real value here. All right, we'll transition talking about the individual stock level, the group level here for stocks. As a reminder, your questions are very welcome. I appreciate you guys taking the time to go on my YouTube channel, drop a comment below the video that you're seeing, and love to hear from you. Would love your feedback on the show as always, but especially your questions, which we can hopefully incorporate into the show when the time is right. What does the heat map look like for you? I mean, not a great day. And I would say what immediately jumps off the page at me is the weakness in technology and the weakness in consumer discretionary. Technology in the upper left, consumer discretionary smack dab in the middle. These are two of the larger S&P sectors, obviously two of the very growthy S&P sectors, and two with the most concentrated color red here today. Within semiconductors, obviously, NVIDIA and Microsoft being down, but 4 of the top 5 stocks finishing in the red is not going to help the XLK for sure. Outside of those top 5 names, look at a number of the semiconductors having further pullbacks today. Micron down 5.5%, AMD down 4%, Lam Research down 3%. I mean, charts like AMD, I mean, at best are just, at best are pulling back, right? But at worst are the beginning of a much further deterioration, right? At best, it's in a pullback, right? It's already not going up, and now it's starting to make a pretty clear pattern on the tactical time frame, lower highs and lower lows. That's the definition of a downtrend. So while the medium term and the long-term trend on a chart like AMD are still fine, if I applied my market trend model to AMD, it's still going to be pretty bullish. But on the tactical time frame, that's how a major reversal would happen. The tactical time frame, the short term, is where you start to see the rotation. And if it builds momentum, then you start to see it reflected on the medium term and longer term time frame. So we start to see longer term levels of support fail to hold. And that's what's concerning me on the chart of like the S&P and the Nasdaq, is we're seeing that same kind of thing. The hard drive makers, Western Digital and Seagate. These are two charts that have been absolutely lights out awesome for quite some time. Are they still awesome? I mean, on a relative basis, yeah, they're still pretty good charts. There's, Western Digital is still above a 21-day EMA. Look at how many times that WDC, Western Digital, has tagged its 21-day EMA since the end of June. I see a bunch of times on this chart, and every one of those previous times, dip buyers have thirstfully and excitedly bought into that short-term weakness, which has propelled Western Digital to another swing high. Most recently was here where we had this sort of short-term, call it a coil pattern, probably call that a pennant pattern, where we have a long-term uptrend, then we have a short-term pattern of lower highs and higher lows. That's a consolidation, an equilibrium. And then finally, we break out a couple weeks ago, break out above the upper boundary, resuming the uptrend phase, exiting that consolidation, bouncing off of the 21-day EMA. We're there yet again. So dip buyers are almost always rewarded, and they're rewarded every time until that last one, right? Greg Morris, one of my mentors, would say all new highs are bullish except for the last one, right? In a continued uptrend, we're looking for higher highs and higher lows. We're looking for the price to pull back to tactical support like the 21-day EMA. And at some point, if things really get ugly here, that 21-day EMA, it doesn't hold. The 50-day simple moving average doesn't hold. The momentum does not remain strong enough. And that's when we start to see real deterioration. WDC for now is holding those tactical levels of support, but charts like this, sitting above the 21-day EMA, where the moving averages are in the proper order, I'm not finding as many of these as I was about a month ago. And I'm not finding as many of these as I was 3 months ago. And I think that change of character is what we're really starting to show. So these leading names that are holding support, I think are still good charts, right? If I own WDC, which I don't, but if I did, I wouldn't be that grumpy about owning a chart that's still holding in there pretty well. But when it starts to break support, when it starts to break those lines in the sand, that's when the chart is compelling us to take action. What you don't want to do is hold on to a name like WDC just because it has been so good previously. We want to evaluate a chart on its metrics, on its merits, right? If it's still a good chart and it's still telling you it deserves a place in your portfolio, then it should stay there. But if the chart's telling you it no longer deserves a place, don't use up that space with an ugly chart. Still okay for now. In terms of things that are working, right, I'm noticing some green, particularly in healthcare, right? And, pharmaceutical names like Merck looking very little like the rest of the S&P. Merck is coming out of a bull flag pattern. We've highlighted that chart. We've highlighted some of the other constructive charts in the pharmaceutical space like Eli Lilly, pushing above 1,000 over the last week. Those are still good charts, right? And as I sign up every episode, it's always a good time to own good charts. So charts like Regeneron making new 3-month highs and continuing to be in an uptrend deserve our attention. Also want to note defensive sectors. We're starting to see some improvement in things like Philip Morris. Still not a great chart, I would argue. Still making lower lows and lower highs. But those are the ones we want to watch to see if there's a change of character. There's some earnings here. I want to say Walmart. Is that true? Yeah, coming up on Thursday. I was going to say, I thought Walmart was a name this week. Home Depot, Walmart, a couple of the big box retailers are reporting earnings. Walmart's like an okay chart. At best, okay. It's not a horrible chart. Horrible charts are below their 200-day moving average. They're in a clear deterioration with weaker momentum, lower highs and lower lows. Walmart for now is holding support. Wait for it at a big round number, $100 a share. I'm not making this up when I tell you that big round numbers like 100 often serve as support and resistance. That has actually been proven with academic research that orders actually cluster around big round numbers. There's still a human component to how stocks trade. And I think that's one of those points that you don't want to ignore. Walmart over 100 is still an okay chart. Walmart below 100, if that's what happened after earnings, would be pretty ugly. Finally, energy, right? Crude oil prices continue to push higher. Apache, APA, which is a name we've talked about, making new 3-month highs this week, very close to doing so, kind of testing the swing highs from earlier in October, maybe exiting from a bull flag pattern and resuming that uptrend phase. Charts like Valero are good charts in any market, right? We're back above the moving averages. The moving averages are in the proper order. We're making higher highs and higher lows. Build a portfolio around charts like that, as opposed to charts that are clearly breaking down. That is my general advice for how to approach investing in any environment. All right, we're going to finish off the show looking at some charts here in a moment, but I do want to give a shout out to my friends at Seeking Alpha, longtime partner to the channel. I actually put out a video last week focusing on one of their products called Alpha Picks. Alpha Picks is a product built around the quant platform that Steve Kress and the team at Seeking Alpha built years ago. I've gotten to know Steve, and I interviewed him for my podcast earlier this year. Really impressed with the approach that he used to build out their quantitative model, which I would argue is within, the realm of the types of models I would have used at a large financial institution earlier in my career. It's called an alpha model, where you try to outperform the market by identifying stocks, showing the correct characteristics of good charts and good stocks previously. Alpha Picks is an additional product where they actually hand select stocks using their quant model to highlight. They do a deep dive on an individual name, and they basically highlight these as potential opportunities. Their latest Alpha Pick actually is going out, I think, today on Tuesday, November 18th. So if you sign up today, you'll have access to that one, as well as all of their previous picks, to get a sense of where they and their quantitative model are showing opportunities. You can find more information at marketmisbehavior.com/alpha picks, where you can just use the QR code that you see on your screen. If you use my link, you get a little better deal than normal, and also helps me to make Market Misbehavior awesome. So check it out. Take a look. marketmisbehavior.com/alpha picks. They have their Black Friday sale going on right now, 20% off, which is a pretty killer deal. Check it out. All right, let's go to the chart review and look at some charts together. Here's the bad news. The S&P 500 no longer in that beautiful uptrend channel we've been talking about for a number of weeks. We highlighted going back to the end of June, we can draw a very clear uptrend channel. Those are the gray lines that you see, higher highs, higher lows, that general trajectory, and that works until it doesn't. But now we have made a lower high, right? Here's the high from about a week ago, clearly lower than that test of 6,900 the last week in October. Now we're making a lower low. We're undercutting that swing low from earlier in November. We are very, very close to our line in the sand at 65.50. As I've mentioned a number of times over the last month or two, as long as we remain above 65.50, our line in the sand, conditions are okay. It's noise more than anything else. However, if we would break below 65.50, that would mean we've broken out from that uptrend channel that was so clear, which means the market is at best going up at a much weaker pace, and at worst starting to really deteriorate. We have failed to hold the 21-day EMA, and over the last week, we've now failed to hold the 50-day moving average. And that's what happened Monday, and now Tuesday of this week. Friday, we closed just barely above the 50-day moving average. Monday and Tuesday this week, we're now closing below. That means we have a breakdown and a follow-through day. So if we would continue below 65.50 through the course of this week, that would be the final level of support, where I think it's reasonable to say that this is just a brief pullback, and they have to start embracing the fact that it may be much more painful. I'll tell you right now, if we would break 65.50, I would be looking around 6,200. That goes back to the previous support we saw in July and early August. That would also be the 200-day moving average. I think that's a reasonable downside objective given a break of 65.50. Also watching the RSI, which just went below 40 today for the first time since the April low. I'll say that again. The RSI finally went below 40 today for the first time since the April low. So if things feel different in November, that's because they are. I would humbly suggest looking at all the charts. All right, let's continue on here. Sorry, I had the wrong view. There's the daily chart. All right. Some other charts just to keep you updated. Newer Dow theory is a modernized version of Charles Dow's foundational work from the early 20th century, where he talked about looking at the Dow Industrials and the Dow Rainbows, the Dow Railroads, the producers of goods and the distributors of goods. One of Charles Dow's great contributions was by evaluating the strength of the economy, looking at two different indexes. If they're both breaking out, that's bullish. If they're both breaking down, that's bearish. You now are an expert, at least an intermediate level analyst using Dow theory. What's happening this week is we have now had a breakdown in the equal weighted Nasdaq 100. We are very, 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 very close to having a breakdown in the equal weighted S&P 500. And if that would happen through the course of this week, that would be a valid sell signal. We haven't had one of those since the February market peak going back earlier this year. So again, we're starting to see breakdown in Dow theory, basic foundational measure of the strength of the equity markets using multiple indexes. Breadth conditions, the short-term breadth continues to be uglier and uglier. We're down to around 38% of S&P 500 members remaining above their 50-day moving average. That's pretty similar to what it was yesterday. Stocks above their 50-day moving average, we're still just above that 50% level. We're at 55%. If that would break down below 50%, the last time we had that rotation was in early March, before we broke down through the 200-day and eventually ended up at the April low. So short-term breadth has been bad. We've covered that. Long-term breadth has still been good, but we're getting very, very close to where I will not be able to say that with a clear conscience. Hindenburg Omen, I'm not going to talk about this much more because I think it's now served its purpose. For me, the Hindenburg Omen is a fabulous leading indicator that almost every major top I've been involved with, we've seen a Hindenburg Omen fire just beforehand, sometimes weeks or days beforehand, sometimes months beforehand, but a successful Hindenburg Omen, which I would argue we did get at the end of October, for me, tells me to be cautious and be, expecting some sort of downside rotation. I think what we're seeing in November is the beginning of that downside rotation. I'm starting to think that 2025 is starting to look a lot more like 2018 than maybe some of us want to expect. It's the last time we had a really painful Q4, which is rare, but it has happened. We got yet another signal there. I think that was on Friday of last week. We've had enough of those that I think, again, I think it's now confirmed that the Hindenburg Omen fired. That tells us, watch out. The Nasdaq 100's bullish percent index is down to 30%. Last time we were down at this level was going into the April low. I'd caution you, just getting down to 30% for me isn't good enough. Getting well below 30%, what I would look for is a move back above 30%. That's often a good tactical bullish signal for the Nasdaq composite. We're getting to that setup where it tells you the deterioration, we may be getting some sort of bounce. But as we saw going into the April low, it can go well below 30%. In fact, at the April low, it got down to 6%, which was one of the lowest readings I'd ever seen. So getting close to where the breadth is actually so bad, it starts to look a little good for the Nasdaq 100. I'll certainly keep you updated there. The VIX spiked higher, Monday. Again, on Tuesday, we were very close to where we were at the October swing low when the VIX got up to around 25 and change. We're at 24 and change today. Above 20 means we're in a high volatility environment. Years ago, I remember interviewing Tim Hayes from Ned Davis Research. They had done some deep analysis on the VIX, and what they found was over 29 was a real bad sign. If you look back in history, the VIX above 29, the returns are usually pretty ugly. Those are usually only in big deterioration periods. And eventually, you always had a bottom, and it ends up being a very viable point. But VIX above 29 tells us we're probably in a really scary market situation in terms of breadth conditions. All right, here's the chart of Bitcoin. We've been covering this. As I mentioned, I still own some Bitcoin and some Ethereum. I did own a bunch of Bitcoin ETFs, and I've sold off almost that entire position here going into the early days of November because of the breakdown below support. The breakdown below the 38.2%, around 104,000, was sort of the final straw where I started, being a little more aggressive in unwinding positions. And for now, we've continued lower. Now we are testing support, I would argue, right now this week at the 61.8% retracement. If you look at the April low, which was down here around 74,000, look at the July high around 123,000, 38.2% of the way down is 104,000. That was pretty much where we were at the October low. You can see in November, we broke below there. That support now becomes resistance, and now we break below there. Now we're testing the 61.8% level. We've also tagged 90K, big round number support. Wouldn't be surprised if there's a bit of a bounce here, but I think breaking below 90,000 for me really suggests a return down to these March, April lows. That's down in the 75 to 80K range. I think that would be a reasonable downside target if 90K does not hold. We're oversold as we're testing a big round number. Tactical bounce makes sense here, but I think until we get better signs of accumulation, I'm concerned about the chart of Bitcoin. Offense over defense has very much gone to the defensive side of the ledger. Both of these, the cap weighted in the top half and the equal weighted in the bottom half, our ratio of offense to defense, both have broken down, made a new monthly low. That equal weighted version is the one that I find more helpful than anything. We've now made a lower high and a lower low. This is now in a confirmed downtrend phase. I'll be less bearish when that's no longer in a downtrend. It's in a confirmed downtrend, implying that investors are getting more defensive. And we're also seeing that reflected in the relative performance of defensive sectors like utilities, healthcare, consumer staples, and real estate. All four of those sectors that I just mentioned are defensive. They're more low volatility. They tend to pay higher income. They're where institutional investors would hide out if they have to have an allocation to equities, but they just want to hide out and try to outperform in a down market. They would naturally gravitate to these types of sectors. All four of those sectors have outperformed so far in the month of November. And as long as that relative strength starts to improve, that's one of the check boxes on my market top checklist. And that's not good. All right, let's talk about a couple of the Mag 7 names. Here's Amazon. Amazon and Tesla are struggling, and that's what's causing the XLY to have a pretty tough day on a day like today. Amazon was down 4.4%, Tesla down as well. The 200-day moving average is right around 215. The 38.2% retracement that we used back here was down around 207, 210. That's the swing low from October. So that's sort of like the downside objective that makes a ton of sense here. That would be a confluence of support, sort of in this 207 to 215 range. The RSI is nearing 40 as we near that support level. Would not be surprised if we get a bit of a bounce off of the 200-day. That's actually happened a number of times since the April low. But if it would fail to hold, that's when charts can get really ugly really quickly. Microsoft looking more and more like a classic textbook double top pattern, with the 550 level tagged back here at the end of July. That same 550 level tagged here the last week in October. We've now broken below these flat 50-day and 21-day moving averages. Now we broke below the 50-day, tested it from below, and now we're rotating lower yet again. The 200-day moving average is down around 465. That's a level I would be watching. But overall, I would say based on the weakening price action, the failure to hold moving average support, and the general weaker momentum conditions, I think that's a chart that is guilty until proven innocent. NVIDIA, of course, earnings coming up here. New all-time high last week in October, and from there, that's been it. The peak was around 212. From there, we had a sort of a short-term double top, rotated lower, tested the 50-day moving average a couple times here in the last couple of weeks, really going back to mid-October. But this week, and particularly today, we're now closing below the 50-day moving average for the first time since really September, right? Was the last time we actually closed below the 50-day. That time we actually bounced off of Fibonacci support and rotated higher. 165 would be the downside objective if the 50-day does not hold. RSI right at 40. I would be keeping an eye there as well. Does anything look good as the S&P is struggling, as breadth conditions are deteriorating? Yeah. As we mentioned earlier, healthcare names, some great charts in there. Pharmaceuticals looking quite good. In the energy space, a lot of energy names looking a lot better. And as crude oil prices continue to move higher, these would continue to do well. APA is arguably exiting a bull flag pattern. We had the runoff of the 200-day, this pattern of lower highs and lower lows. We break above there about a week ago. And overall, we're continuing to hold pretty well. Would love to see some follow through above 25.50, maybe 26 to clear that resistance from last week and also from back here in September. However, if that would happen, that would really resolve this pattern to the upside, similar to what we saw back here in August, as a breakout above a consolidation pattern signaled much further upside, maybe setting up with a similar pattern here on APA. Folks, that will do it for today. There's a rundown of where we're at. Again, I'm seeing a lot of signs of deterioration. We've covered a lot of those in terms of breadth and momentum, but now I think you're starting to see some deterioration in price action. We will be laser focused on the chart of the S&P as our line in the sand of 65.50 is getting closer and closer. Please keep watching through the course of this week as we navigate through key support levels, as we talk about leadership, particularly NVIDIA coming up on earnings, and try to highlight opportunities like energy and healthcare where the charts are good despite weakening market conditions. If you have any questions, use the comment section on our YouTube channel, and have a wonderful night. For Market Misbehavior, I'm Dave Keller reminding you, it's always a good time to own good charts. Take care, folks.